Firstly, we went back to early June. We actually hit the bull market. This is where the S&P 500 rose 20% from its low in October to just over 20% now. This is just 9 months into a bull market. And at Evelyn Partners, we look back at the previous bull markets going back to 1970, and there were 7 of them. The average length of a bull market is around 5.5 years. So we're still in the early stages. In other words, once stocks enter a bull market, the history shows that these animal spirits take over. And this provides stimulus to the real economy by lifting consumer and business confidence to drive the longer market rally. The second point to make here is, yes, the rally has been quite narrowly led by the artificial intelligence themes. But should investors' sentiment sour this theme, this could drag down the overall market. However, Evelyn Partners, we do look at the technicals. We find that there is growing evidence that the AI-led rally is spilling over into the broader market. So, for example, over 70% of the companies in the S&P 500 have recorded positive returns over the past 12 months. So that does suggest to us that the market is starting to broaden out a little bit.
Daniel, one of the big risks that we've all been talking about in this higher rate environment has been housing across all Western economies. Yesterday in the U.S., we got a pretty blockbuster housing starts number. It was off the charts, much stronger than anybody had expected. What do we do with this number? What do we read into it? Does it suggest that the housing market potentially has bottomed out? And I wonder if this adds to the bull thesis.
I think the key point here, it tells us that the consumer is still strong. In terms of their spending power. If you look at if you look at excess savings that consumers have since the COVID era policies, we find in the US they're roughly around 6%. They're 7% in the Eurozone, 8% in the UK. And what that suggests to us, with a full employment in these economies, it does suggest that consumers remain very resilient, and that suggests any sort of risk of an economic hard landing has diminished over the past 6 to 12 months.
Well, it does feel like how much firepower the U.S. consumer has left is central to where the U.S. economy goes from here. And I take your point. Yes, the consumer has been resilient, but you also have to, acknowledge that U.S. credit card debt now stands at a record level, and APR rates at a record as well. I believe north of 20%. So clearly, there are still some risks in the system.
Yes, I mean, when we look at the consumer, we're looking at the consumer in aggregate. While consumer credit has obviously picked up, if you want to look at the overall debt to the consumer, which also includes mortgages, these have been significantly reduced since the global financial crisis in 2008. It's also worth bearing in mind that when we had COVID era policies, mortgages were refinanced at very low levels. So, for example, if you want to look at how many mortgages that are paying more than 6%, the mortgage rate's currently 6.8%, it's only 7% of outstanding mortgages. The bulk of mortgages in the US are at rates at 5% or lower. So what that tells us is that consumers have a little bit of a cushion against these higher interest rates, or the interest rates will happen with a longer lag.
Just give us a view on the dollar as well, because the dollar's rolled over in recent weeks. We look to whether there could be any support coming through on that interest rate story if we have a hawkish Powell. Do you think dollar is on course for a lower trade from here?
Yeah, our view at Evelyn Partners is the dollar's got further to go down. There's a couple of points here. Firstly, the Fed has paused on interest rates, while other central banks like the Bank of England will know later on Thursday that they're going to raise interest rates again and in subsequent meetings. The same thing for the ECB. They're sounding hawkish as well. So when we look at that interest rate spread between the US and, say, for example, the UK or Eurozone, that's continuing to narrow, and that's driving down the dollar index. And the second thing is, if we have a better growth outlook, given that the dollar is a counter-cyclical currency and strengthens in times of risk aversion, it just tells us that with a stronger economic growth environment, the dollar is likely to go down. So with rates narrowing, with growth improving, this is generally not good for the greenback.